Hello YouTube. So here's the thing. Your brain is wired to lose money. That's the fact of it. Let me explain that for a minute. Your brain was made for survival. Millions and millions of years of evolution has taught our brain to run from pain, to avoid pain at all costs.
I just want to survive, that's all.
So this is why the pain of losing $100 is more than the joy of making that same $100. And this is not good for investing. So what does this mean? This means that when you see your portfolio dropping from 100,000 to 90,000, those neurons in the brain, they start firing. And once they start firing, the next thing you do is you're selling. You are looking for safer things to invest into. If you're holding Bitcoin, for example, you start selling because that Bitcoin is dropping very fast. And mind you, I don't encourage people to be buying Bitcoin. Only invest money that you're prepared to lose. This is a situation where you've got two primary emotions, and I'm going to go through this in a moment with you. So the two primary emotions that we see in investing, we've got greed and we've got fear. So what happens when the stock market is going up? What happens when you see green in your portfolio every day? Things are going up. Your favorite stock is going up. If you put money into your portfolio, you know that 100,000 portfolio today, tomorrow is now at 105, 106,000. What does that mean? That produces happy hormones. So what happens is people start to get greedy. They start to chase the market, investing more and more into a rising market. And what happens? This greed will backfire sometime. So a lot of the times we FOMO into hype stock. Damn! In a bull market, we find people throwing money at the market. And this happens because people have gone on the extreme side of greed. And what then happens? People FOMO into stocks. So FOMO is fear of missing out. People then FOMO and buy at the top. And then we've got the other side of fear, where you are in a bear market and people start to panic. So pessimism kicks in, and people hate to lose. As I said earlier, they'll then start to sell because their portfolios are going down. Now this creates a vicious cycle where people buy at the top and sell at the bottom. There's a report out there, it's called the Dalbar report. I'll put a link down in the description below. It's called the Dalbar report. This report talks about how a lot of investors who are engaged in this cycle actually end up underperforming the funds that they buy into. Now, if you have followed me, you know that index funds, the way I describe them, is where you actually make returns that are the same as the market. But this is not possible if you are engaged in this vicious cycle of buying the fund at the top and selling at the bottom. You actually underperform that fund. So this report, the Dalbar report, actually came out and said people are making 4 to 5% returns on funds that are supposed to be making them 10%. And this is because they buy high and sell low. So what do you have to do in order to control these urges? Discipline in the market is not easy for most people, even for me. So you need to have a system where you are investing into the market, come rain, come thunder, come high water. You are investing consistently, and I do this by setting a direct debit into my investing pies, into my investing portfolios, which works on autopilot. So I don't have to measure the market, I don't have to All I have to make sure is that I am buying companies that are on the margin of safety that I want. I'm buying undervalued companies. I'm buying companies at fair value. And I would have done my research, I would have done everything. So everything has been screened. I've done my research, I've put my shares into the pie, and that direct debit is just going month by month. So when the stock market goes down, I buy more. When it goes up, I buy less, and that's dollar cost averaging. And by dollar cost averaging, you'll find that your average costs that you pay for a particular share or particular stock is actually lower, because you buy a lot more when they go down. Be calm, don't chase hype. You have to review your investment plan. You have to dollar cost average into your stocks. You have to be patient. Discipline beats emotion. If you can't control your emotions, the market will control them for you. So if you don't get anything out of this video, just get that you have to control your emotions when you're investing. A lot of people, they don't make low returns because they're idiots, or they don't know what they're doing. It's simply emotions getting in the way. So manage your emotions, manage your psychology, and you will be golden in the market. Happy investing, and see you in the next video. Peace.